Welcome back. Today we're going to have a fun conversation talking to my personal mortgage broker, Robin Bowman. We're going to go through all the details and all the bits and pieces that are involved in getting yourself a mortgage. I've said it a bunch of times. I don't pay cash for houses. I finance my homes. I get a mortgage for my homes. That allows me to stretch the money further, buy more homes and all that. So for me personally, this is how I leverage mortgages and banks to buy houses. And for anyone who's looking to buy a property, it's a good conversation to let you know everything you need to do to prepare to buy your home and to qualify for a mortgage. The only thing I pray is that my lease don't fail me now. I have with me here today my good friend and broker, Robin Bowman.
Thank you, Dayton.
You're welcome.
It's great to be here.
So we're going to dive into all the questions that I have and all the questions I think people have around what it means to finance a home. So what do they need to do to get prepared to buy the house? How do they qualify for a mortgage? What you're doing on their behalf behind the scenes to get them through the process to finance the home. I guess to start, before I dive in deep into the questions of home buying, I will let you give a quick intro. Tell me about yourself. Tell me about...
Awesome. Well, first of all, thanks for having me. So I have been in the mortgage business for, my goodness, over 30 years. The first company I was employed with, I started as an assistant to the president. Started working out of a real estate office in Doylestown. Then I was in New Hope. Met you, Dayton, when I was at the Chestnut Hill office. And we've been working together now for, I don't know,
about 20 years.
20 years.
Yeah. The reason that I wouldn't even consider another broker is because of, one, your ability. If you tell me something is going to close, I know it's going to close. There's no question in my mind about that. I have gone through other lenders, I've gone through other hard money lenders, gone through other brokerages, and everyone's word when they say it's going to close doesn't mean that.
No, it doesn't, and that just, you need to be working with a reputable lender and someone who's experienced. The biggest part of being a loan officer is knowing what questions to ask up front so that you can set the expectation with the borrower so that they know what they need to do, what they can expect, what documentation they need to provide to get to the closing table. It's really not difficult.
Yeah.
It's just that you need to know very specific information about your client so you can make it a good experience for everyone.
Sure. You say not difficult. I remember the first guy that I ever dealt with, I was telling you about him a little bit. I found him online. And we pushed the closing date off 4 times before we finally closed.
Yeah, and it's not good.
Each time he said it wasn't his fault. I'm sure it was his fault. That has never happened with you. Help me explain the process of financing a home. So we buy a house, we see a house, we go out, me and my wife go find something we love, we want to buy it. This $200,000 home looks great. I don't have $200,000 to go buy this home. So the difference between cash, I come out of pocket, spend $200,000, it's now my home.
Yep.
Or I go to a lender and borrow $200,000. Tell me about the process. Explain the mortgage process.
So what I would tell you, you know this, but what I would tell you, the audience, is that before you even start looking for properties, you need to talk to a mortgage consultant or a loan officer. You need to find out first exactly what you qualify for. And what that means is we need to know how much do you have in savings that you can use for a down payment and pay for closing costs. We need to know, are you a W-2 employee and how long have you been working for your company? You absolutely need to have a 2-year history of employment before we can consider doing a mortgage. We also have to look at your credit, right? Lots of times we talk to individuals who may have had a challenging period. We need to know what happened and what we can do to help that person get their credit in line in order to be able to put an offer in on the property. So all of those things are so important. before you go look for a house. The last thing a real estate agent wants to do is take you to a home that you absolutely fall in love with. Fall in love with it, right?
Can't buy it.
Unfortunately, you can't qualify to buy that house, and that is just such a huge disappointment, right? So, long story short, you get pre-approved with a reputable lender. You know how much you can get qualified for, get approved for. You know how much money you're going to need.
Sure.
You know what your estimated monthly mortgage payment is going to be. And now you have the confidence to go in and submit an offer.
Yeah.
Right?
Yeah.
So you're going to submit an offer with a mortgage contingency because you don't have $200,000 to come out of pocket with and pay cash,
Sure.
right? Okay. So you get a mortgage. My house is the collateral for the loan. That is your mortgage. Your mortgage is the collateral for the loan. So if you don't make your payments, then the bank or your mortgage company has the house as collateral. So that's
Makes sense.
really how the mortgage comes in.
Question for you, because I've heard this question asked a bunch where people are saying, well, my credit's bad, so I need to approve my credit before I start the process. And to a degree, they're correct. There are certain thresholds of credit where you're going to be just disqualified completely from a loan.
Right.
But there are varying degrees of good credit, and the impact to that is going to be on the rate. So can you explain a little bit about if someone's, I don't know, if they're targeting a 700 or a 650 or a 600, whatever their target credit score is that they're trying to achieve to help them out on the back end for their loan, it doesn't necessarily disqualify you from the loan if you have lower credit.
It doesn't.
But just explain to me how that does impact your loan.
Okay, right. So think about it this way. The lender doesn't know you, right? So they're looking at your credit to determine what their risk is.
Sure.
Okay, so credit scores range from in the low 500s to the top range. I think the
850.
highest credit score is an 850 out there. So if you're a borrower who has a great credit score, you're going to get the best interest rate,
Sure.
the lowest interest rate. If you have someone who has a mid score, maybe 700, 720, you might be paying an eighth to a 1/4% higher than someone with an 850 credit score.
Sure.
Most lenders on the conventional side have a minimum credit score of 620. If you have a 620, odds are you're getting a higher interest rate. Could be 3/4 of a point higher to a point higher in rate.
Sure.
But the other thing that may happen on the lower score is that you may be required to pay points.
Now tell me what a point is.
Right. Points basically are a borrower paying interest up front to have a lower interest rate over the term of the loan. Points, when you have a lower credit score, are really designed for the risk involved and for the lender to want to give you a mortgage.
Sure. Penalty points.
Right. So 1 point is 1% of your loan amount.
Got it.
You can pay an eighth of a point, you can pay a half of a point, you can pay 2 points. Most people, especially in today's market, they are starting to lean towards points to get a lower interest rate.
Got
So 1 point may drop your rate from 6.5 to 6 3/8.
Sure. Or
Lower, 6 1/4.
Okay.
So
1/4 of a point, or 1/4% for the point is what we're seeing today. Is what you're saying.
right.
So I'm going to recap what I just heard. So lower credit scores. Obviously, we all want to target an 850. I don't have an 850.
It's hard to get to 850. It's very hard to be at 850.
But if you are there, you'll get the best of everything. You get the Cadillac of the mortgage
You
company.
do.
You pay the littlest amount of money out of pocket, and you still get the benefit of a lower rate. And the lower rate translates to a lower payment on the loan that you're borrowing
Correct.
to buy the home. When you have, if you have a lower credit score and you're down, like you said, in the mid sixes or high sixes even, I think, you're still going to be subject to points. which is essentially the penalty you're paying up front to get the loan at the rate that you want. Now, I heard you say half a percent or an eighth of a percent. So we're talking about the interest rate on the loan. That's the interest that they determine on your loan that you pay back, which really dictates what your monthly payment is.
Correct.
For perspective, because people hear that, I don't know if they get the actual dollars associated with that. If I have a mortgage with a rate of a 6.5 versus a mortgage with a rate of 6.75%, what does that translate to on the loan? Give me a ballpark perspective on this $200,000 home, for example.
So the difference in payment between the two interest rates could be between $50 to $100 a month. It really depends what the difference in rate is.
Sure. So, I mean, I think that's important to say, because I think people hear that and they're thinking, okay, well, I'm going to wait to do this. I'm going to wait to buy until I get this perfect percentage.
Right.
And you're talking about $50 to $100 per month that you're going to save.
Right.
So, for me personally, I'm a little different because I look at houses as an investment. So, if $50 to $100 is going to disqualify an investment, it's a bad investment anyway.
Correct.
So for me, the rate isn't as critical. It's more so about my cash flow. But even for a home buyer who's living in the home, you're talking about if you see the home of your dreams and your mortgage on this $200,000 home, maybe it's $1,200 or $1,300. If you have a poor rate, a worse rate, now it's $1,350.
Right.
Is that going to dissuade you from buying the home?
Yeah, it's not the end of the world. It really isn't. And it doesn't make a huge difference.
Sure.
So a lot of people, instead of being focused on the rate so much, focus on your monthly payment and what you're comfortable with. And if that monthly payment is going to cost you a half of a point,
so be it.
Then go for it.
I agree. I mean, that's my perspective. I tell people that all the time. Like, don't let you hear market is this, that. I don't want to buy. If you want that house,
yes,
that shouldn't dissuade you.
Right. Look at the payment.
Sure.
Not the rate.
And I'm not discouraging people from fixing credit.
No, and we all want the lowest rate possible, right? Everybody wants the lowest rate possible, but a lot goes into the rate.
Sure.
So take a minute, just think about what your monthly payment is and how comfortable you are making that payment.
Understood. So the other part to that, so I'll keep up with my $200,000 example. You're buying this home, you don't have $200,000.
Yep.
You're going to go to your broker. They deal with a bunch of lenders, or maybe one primary, and then they're going to give you the money to buy the home. What is my obligation? How much do I need to pay? Tell me about the full range of people and what they can pay. I know what I pay as an investor is different from what, Joe somebody pays to go buy his family home.
Right.
Tell me a little bit about what they can
So there's a lot of different variations to go into it. First and foremost, if you're a first-time home buyer and you're going to occupy the property, you can do as little as 3% down. So on a $200,000 house, that's $6,000.
Yeah.
That's not, it is a lot of money, but it's...
Perspective, it's not...
Right, 3% down.
It's not $200,000.
Yes, 3% down. And then you're also going to have closing costs, right?
Sure.
So a really good way to just estimate off the top of your head how much closing costs are going to be is to take about 4.5% to 5% of the price. And that is going to be an indicator of what your closing costs are going to amount to. So now you take your down payment of $6,000, you add, if we're using 4% of the price as closing costs, we're at 8, right?
Okay. Yep.
So 8 and 6 is 14,000 to purchase a home with as little as 3% down. It's not that difficult. It's not that difficult. Now, the less you put down, so 3% down, right? The greater risk the lender's taking.
Sure.
And so because you're doing 3% down, you're taking a higher interest rate, slightly higher. And you do have to pay what's called PMI.
Gotcha.
Okay? So now that's a whole nother subject. So PMI stands for Private Mortgage Insurance. This is insurance to the lender in case you default on the loan. And it is required to be paid unless you're putting 20% or more down.
Got it. So that makes sense. So that's not money they're paying up front. That's just money that you're going to pay in your monthly payment.
In your monthly payment.
Got it.
Yes.
So on that
Yes.
loan, and just for the same $200,000 example, the down payment is what you're paying towards the $200,000, and the $194,000 extra, so the 6 plus the 194 makes up the full $200 that you pay the seller. The bank is giving you.
We're giving you that check at the
$194,000.
settlement. And then once you settle on the loan, you're most likely doing a 30-year mortgage.
Yeah.
Right? So
Most people.
most people are doing 30-year mortgages. There are also 25, 20, 15, and 10-year mortgages. As you get down into the lower term mortgages, you're going to get a more favorable interest rate. Again, because the risk to the lender is less if you're taking on a shorter term loan. However, you're paying that loan back in a much shorter period of time, so your payment's going to be double what it would be
Sure.
on a 30-year mortgage.
Sure. In the 10 years, let's just assume you stayed there 10 years,
Yeah.
that you stayed there, you've paid down that loan,
Right.
10 years worth of payments. Part goes to the principal, part went to the interest that they take, but the part that cut off that, so back to the $200,000, I borrowed $194,000 of it. In 10 years, maybe I paid off $50,000 of that loan.
Right.
I only owe you $140,000. So now, also, real estate always goes up. That's why I invest in real estate. So it's worth more than the $200 I paid.
Worth way more in these times.
Absolutely.
Right?
So
Yep.
10 years from now, it's worth that much more. And so when you sell the house, you're going to get the difference between what you originally paid. So that comes back to you. Plus whatever it's called equity, whatever additional money you have in that home, you've got more equity from
Correct.
that. So now
Yeah.
you have that coming back to you as well. So, I don't know. I don't think there's ever a real lose scenario there.
No, I don't think I've ever seen a lose scenario with investing in real estate. And you're an investor. You know how it works.
Absolutely. It was funny. I was telling somebody the other day. We were talking about a project where something went wrong and the lady destroyed something, and I was telling them, yeah, it happens. And does it suck? Of course it sucks.
Right.
But in the long run, I'm still making money on the house.
Absolutely.
Am I upset that I have to deal with this? Sure I am. But there's not one house that I have ever bought that I have lost money on. There's one time I paid at the closing table. That's because I took money out in advance of the closing table, refied it and cashed out. And so I took my equity out before I sold it. And so that, I don't know, 50 grand or whatever I took out of that particular house. When I went to sell it, I had to pay like $4,000 at closing because I already took the equity out. And I was explaining to somebody, it's not losing. I just took it out early to go buy another house.
Right. You were just using your equity
Precisely.
to get to the next house.
Precisely.
Exactly.
So it's when you put that on a balance sheet, it's still in the green. It's still positive. So I don't know. That's I invest in real estate.
Absolutely.
Buy rentals.
Absolutely.
So there are some clients that I take on as a contractor and help them through the process. They see a house needs work. They're borrowing the money to purchase anyway. They don't have $100,000 to fix it up as well. So they'll take out these special loan programs where you can purchase the home and take out some extra cash to fix it up.
Absolutely.
So first, before I go into like scenarios of specifics, explain how that works. If I wanted to buy a fixer-upper.
Okay. So if you want to buy a fixer-upper and you want to upgrade the kitchen and the bathroom, so let's just make this easy, right? So we'll make this easy. So you find a house, you submit an offer, you're going to submit the offer at whatever price you want to offer.
Sure.
You have to have in your mind an idea of what the cost is going to be to get yourself a new kitchen, get yourself a couple new bathrooms, right? Maybe that's $30,000. I don't know. You're the contractor, but we'll say $30,000. So when you go for the mortgage, you're going to go for a renovation loan, and we will take the after improved value of the home, and we'll finance off of the after improved value. So we're going to have a consultant or the contractor do a list of required repairs. So if there's anything in the property that is a health issue, they will require that to be taken care of. Then you can add on any cosmetic upgrades that you would like, such as the kitchen and the bathroom.
Gotcha.
We come to a number that gets added on to the base price that you're paying for the house. And now we're going to finance, we're going to give you a mortgage amount, in some cases up to 96.5% of the after improved value. That's on an FHA loan. On a conventional loan, they'll go to 95% of the after improved value of the home.
Got it. And so they're still bringing 5% or 3.5%
Correct.
of whatever that
After improved value is.
Okay.
Correct. So now you have to be qualified
For that larger
on
amount.
the larger amount.
Sure.
Right.
Sure.
Right. And it's a similar process as when you're just purchasing a home, but there are other people involved.
The one example I was explaining to you that I was doing, lady bought a home. They don't know anything about construction, so they hired their contractor. They had to select their contractor in advance, and the contractor and the loan officer spoke, and they coordinate all of the things that are going to happen with the home, like you just
Correct.
described, and they end up coming up with their renovation budget and cost, and then the lender uses that to roll it into the new mortgage price. Then the lender hired their own personal consultant who is vetting what the contractor said. So this is
Okay.
the in-house expert that oversaw what that contractor had said, the kitchen cost, the bathroom cost, this cost, to make sure it's actually accurate, because when they lend the money out back to risk, if you're telling me a kitchen can be built for $10,000, they want to say, is that really factual? Can you build a kitchen for $10,000? You can't, by the way.
You know, it's tough in this market right now. There's not a lot of inventory, and everybody seems to want the beautiful, blinged out,
Of course,
move-in ready homes. Unfortunately,
those cost.
it costs a lot
Premium.
of money, and there's not a lot on the market. So right now, like, open your mind, look at these smaller properties that you can buy for,
Yeah.
300,000 is much more affordable than 700,000, and make it your home with a renovation loan. Go in,
I agree.
add on bedrooms, add on a bathroom, remodel. You can include in these renovation loans, correct me if I'm wrong, I'm pretty sure you can include rugs, you can include hardwood floors, you can include paint. Everything can be added into a total renovation.
Absolutely. I mean, for perspective, if you're saying 3 to 7, I mean, it's always more advantageous to you to pay for the construction than it is to buy something that's already finished. Someone's charging you a premium for the work that they have done,
Absolutely.
and that's in their image. Now, you have to live through a renovation, and that's scary to a lot of people. I understand that. I mean, I hear homeowners every day tell me how nerve-wracking the experience is. But if you can wrap your head around going through the process, I mean, you're going to win in the long run. Your value in the home is going to explode exponentially.
One of the really helpful things with the reno loans too, and not a lot of people know this, is that mortgage companies will allow you to finance, I think it's up to 6 months of mortgage payments while the renovation period is happening. And that's a good point too. The max term for a renovation is 6 months. And I believe on a VA it's 4 months.
Okay.
So you can do it on a VA loan as well.
Got it. We're 6 months is the term that we're doing.
Right.
I didn't know that there were term limits to it. But that's what we're doing on this.
I think they will do extensions if there were extenuating circumstances. Weather could be one of them if you're buying a property in the winter, and outside things can't
Sure.
be done due to weather, that could be an extenuating.
Yeah, and they also have like these other contingencies in there for like the unknowns. So it's not. They
Right, I
cap
think it's
it at
10%.
Yeah, and they hold, the
on
bank holds that, and it'll come
contingencies.
back to the lender. So if we don't use her contingency, she gets it back. Let's say to the lender, to the buyer, she will get
Right.
the money back.
Exactly.
So like I know at least from the perspective of someone who's going in, it's construction, something's going to go wrong.
Mhm.
Yeah, well the bank
sure.
is hedging their bets against that too, so they're holding that on your behalf. I'll tell you, I'll let you kind of fill in the blanks here with the story where my last rental property that I just bought with.
Yes.
We ended up having to bring in a construction loan.
Mhm.
So I'll set the stage. I'm walking through. So I buy properties. I love the Mount Airy area. I love Northeast Philly. I love Roxborough area. I love these areas. So this particular house is in Mount Airy, and beautiful home, and it was bank owned. We go walk it down. I knew immediately I wanted it. I called you.
I remember.
And I asked, so because it's bank owned, I know there's a lot of investors. So what that means is I'm up against it and I'm competing with cash. And so if I don't want to pay cash, I need to make myself just as attractive with a quick close. That not only, if you're going to say quick close, a reputable person
Correct.
behind you saying
Yeah.
that you can close quickly. And then they see that, and then usually that'll help you compete with cash. And so that's how we went in. And I went in aggressive because, again, I took a look at what my monthly payment would be, what my prospective rents were,
Yeah.
and it was a win.
Yeah.
So that's how we went in. My offer was aggressive. It was accepted. Dealing with the bank is a little bit different because, they have so many different layers of approval before you get the thumbs up. But once we were done and approved, we had a 2-week close. And I don't know, after the first week, I get a phone call from Janet, my agent, who says, hey, the person, the old resident came back to the house, broke in, and did some minor damage to stuff. And the bank spoke to Janet and said, are you guys okay to still move ahead? It's only minor damage. This is the bank talking to Janet, dressing this up as minor damage. So she called me. I said, well, what does minor mean?
Right.
Minor to who?
Could be minor to them, like the major
exactly, to you. Exactly. And who's paying for it? Because I already gave you an offer expecting this to be a nice polished home. It was move-in ready.
Yeah.
I planned on closing and then showing the house the next day. So we ended up, I was like, hold on, before we say yes, we're going to move ahead, let me go walk through the house and see, because no one had pictures either. So it wasn't minor damage.
No.
The kitchen was destroyed, glass was broken, windows were smashed, doors,
Toilets were smashed.
toilets,
Right?
the light fixture yanked out of the ceiling, every
Mirrors were
every mirror
smashed.
hammers through the
Yes.
walls. You name it, she broke it.
Right.
But so it wasn't minor. I calculated, I don't know, I think I said something like $15,000 to $20,000. That's assuming I'm doing the work. So it's my labor, it's my efforts, but it would be a good $30,000 to $40,000 renovation if I were a homeowner hiring out a contractor.
Right.
But either way, my material time and whatever being 15 to 20, that has to be compensated some way.
Sure.
So that opened the door for negotiations and further discussions, changing the price of the property. We renegotiated the price, and then we had to go lump in a construction loan.
Right.
I'll let you pick it
So
up
we
from there.
switched. We had to pivot because no convention. So Dayton had put an offer in. The mortgage was going to be a standard
Yeah.
20% down investment property. However, when something like this happens, and hopefully this doesn't happen to you, but if something like this happens, a conventional lender or even an FHA lender will not lend on a house that is not habitable.
Yeah.
I mean, you can't live in a house that the toilets are smashed, right? So I say to Dayton, so this is going to be a problem. We're going to have to pivot and do a renovation loan. surprisingly, the bank was very agreeable to all this.
Yeah.
A lot of times you'll run into major issues with the bank on the side of the seller because they want their money.
Absolutely.
And they want it fast.
Yeah. I mean, I was explaining to, when it happened, I didn't think they were going to play ball. I figured they were
I
going to
didn't
go back,
either.
go to
I
one
was
of the
like,
cash
oh no,
offices.
here
Yeah.
we go.
Yeah, it is.
But
It was, I mean, and that kind of speaks to, again, the reputation of everybody involved. I mean, the agents knew each other,
Yes.
had a reputable lender, so all of those things made the seller, being the bank, who they really just want their money.
they
could
really
care
do.
less
If they
who's paying
don't,
you.
you're right.
They just want to get out because the longer they have that property on their books without a
They're
mortgage,
losing
they're
money.
losing money.
They're
So
losing money.
they don't care if they take a cash offer that's $10,000 less. They just want to be out and done. So it was one of those things where I was like, all right, well, you still gotta make it somewhat palatable for them, but by the same token, you're relying on all the reputations to let it happen. Anyone that's trying to extract from this what their checklist of items are when they want to go attack their first home, go get qualified for their
Yep.
mortgage for their first home, run us through that quick checklist of what you need to be prepared to go ahead and get your mortgage.
Yep. So just a few things that you need. Number one, you need to be employed for 2 years, and you need to be able to provide your most recent pay stubs for 30 days. Along with that, you're going to need your W-2s for the most recent 2 years and 2 years tax returns. So that will take care of the income part. For the asset part, you're going to need to provide 2 months of your most recent bank statements, right? So that's checking, savings, money market, mutual funds, even a 401k, any retirement statements. And that's pretty much it. We're going to pull your credit report. So you may want to just know what your credit's like before you start talking to a loan officer, okay?
Sure.
Obviously, if you've had a couple bumps in the past, that shouldn't really impact things, other than, you know, your credit score. But you can always work on your credit before you go and put an offer in on a property to get the credit score up.
And just for the kind of baseline, I understand the better the credit, the better the rate, the better
Correct.
the situation. What is the bare minimum credit where you would suggest don't start the process now, work on your credit? Is that a 600? Is that a
Well, you can get the minimum credit scores is 620,
620? Okay.
but you're going to pay a high rate.
Sure.
So whatever you can do to get your credit score up, I would suggest that you try and do it. I'm going to give you, this will be one of the best things you can do to get your credit score up. If you're using your credit cards, okay, you want to keep your outstanding balance to under 50% of the high limit on the credit cards. Once you go over 50%, your credit score is going to go down, okay? So the quickest way to get that credit score up is to pay down your credit card balances. Really important.
So take me through. You get a phone call. Dayton likes a house. I want to buy this. Robin, help me out. I want to close on this date. What are you doing next?
Right.
What's
So
happening?
basically, once your offer is accepted, we got a copy of that agreement of sale. We're collecting all of the documents if we haven't already done that before you put an offer in, right? So when you're getting a mortgage, it's simple documentation. We need a month's worth of pay stubs if you're a W-2 employee. If you're self-employed, we need 2 years tax returns. Full tax returns, all of the pages. We need to see that you have the money. So we need your most recent 2 months bank statements for all of your accounts. That's the major paperwork. I would say the biggest part of the puzzle are the assets, right? Because you have to show where the money's coming from. If you have a large deposit, all of those funds need to be verified. Some people get gift funds. Some people are lucky enough that their family is able to provide them a lump sum of money to buy a house. Well, we need to be sure that you didn't go down the street to Tony Baloney and, borrow $10,000, because you cannot do that. Anyway, we gather all of this information. I review it. I make sure it all makes sense. Once I'm okay with it, it goes into our processing department.
Okay.
And then you have a processor who's ordering the appraisal, who is ordering title insurance. Most times the real estate agent is ordering title insurance,
Okay.
but sometimes we will take care of doing that. We need to see if the property you're buying is in a flood zone. Believe it or not, you might be surprised. And then they're basically double checking my work. They're making sure we have everything we need. If there's something missing, they're going to reach out to you as the borrower and ask you to provide that documentation. Once the processor has done their review, they're going to submit it into underwriting. And underwriting is going to review everything. The underwriters, we love them. We're very nice to them. We get them what they need to get a loan approved. Once the loan is approved, you get what's called a commitment letter. That commitment letter not only goes to you as the buyer of the home, it's also sent to your real estate agent. That real estate agent is going to send that off to the listing agent. So now the listing agent and the seller know that you're approved. Once you're approved, there's still all kinds of things going on in the background. We're verifying employment. We have to verify within 10 days of settlement that you're still employed with the employer that you stated on the application. There have been numerous times where people changed their jobs after they got approved. And honestly, if you think about it, they're approved, right?
Yeah.
They're like, okay, I'm good. I'm going to go to a new company.
And does that kill a loan, or does that just kind
No,
of
not necessarily.
have to?
Not necessarily. Hopefully you're still making the same amount of money.
Sure.
You're just with a new employer. We
Yeah.
may require that you give us your first pay stub.
Sure.
But as long as you're making the same amount of money,
It's
you're
all good.
golden. You're going to be okay.
Yeah.
The other thing you really shouldn't do is please don't go buy a new car.
I was gonna say buy a car when you said your job. Like,
Please
buy a
don't
car.
go buy a new car. That will definitely cause an issue.
Sure.
You
sure.
really can't change. Once you're approved, try not to make any changes to employment, to your income, or to your debt, because that will absolutely have an impact on your approval. So we're still gathering information, insurance, title docs, and things come up on title sometimes.
Yeah.
You know, judgments
Water
or
bills.
liens, water bills, yes, things of that nature that, you know, may have an impact on
Got
the
it.
closing. But then you get to closing, it's closing day, it's settlement day, we're gonna all gather together around a table,
Sign some docs.
buyer's gonna sign a packet. Actually, it's not that big anymore.
It's not terrible.
Oh, and just so you know, there's no cost for
For-
pre-approval.
Okay.
Right?
Okay.
It's totally free.
That's good information.
It's totally free.
And if
And it only takes,
it's quick. I mean,
it's quick because you do it online.
yeah.
And so your loan officer should be able to get back to you within 24 hours on that.
Very cool. So there really should be no excuse not to have a pre-approval to go out and look
No,
for
you-
houses.
I will tell you, most of the times an agent is not going to take you out
That's true.
unless you're pre-approved.
I agree.
That's
I
the
mean,
first thing you need to do.
yeah. I mean, I think most of the seasoned agents aren't doing that.
They're not.
They're not wasting their time because, yeah. I mean, you don't, like you said, showing someone a house that they can never afford. Why
You don't want to
wasting
do
their
that.
time?
Yeah.
Yeah. So no, it's a good point. Good point. Good information.
Yeah.
Thank you.
You're welcome. It's great
All right.
being here.
Wait, what are we doing?